Good evening, ma'am, and Pradeepa, ma'am.
Yeah.
Voice is not clear.
Good afternoon to everyone present here. On behalf of the Department of Corporate Secretaryship, Shift to Agachal Manual Jain College, I am Tarni R from BCom CS. Warmly welcome you all to today's national webinar on raising capital and managing finance for startups, organized in collaboration with the Association of Mutual Funds of India. We truly appreciate your presence here today. Now I invite our respected Deputy Dean, Dr. R. Sureka ma'am, to deliver the inaugural speech. Over to you, madam. Before the inaugural address, we start with the prayer song. Yes, ma'am. Now I request facilitator Dr. M. Kaveri ma'am, Department of Corporate Secretaryship, to deliver the welcome address.
A very good afternoon to one and all present here. On behalf of the Department of Corporate Secretaryship, I'm happy and honored to welcome you all to the one-day national level webinar on raising capital and managing finance for startups. It gives me an immense pleasure to welcome our respected dignitaries, our Secretary, Sri Udan Kumar Chodia, Associate Secretary, Sri Hemant P. Chodia, Dean, Dr. M. Ramya, Deputy Dean, Dr. R. Sureka, and Director, Dr. N. Venkata whose presence encourages and support all our academic efforts. I am also delighted to extend a special and heartfelt welcome to our chief guest, Mr. Veera Brahmarao Arikapudi, Senior Consultant, Association of Mutual Funds in India, Andhra Pradesh, South India, former General Manager of State Bank of India. We are truly honored by your presence and look forward to your valuable insights. Welcome, sir. I would also like to welcome our fellow faculty members from various institutions whose enthusiastic presence adds value to this academic venture. Once again, I thank you all for being here and I wish you an enriching and meaningful experience throughout the session. Thank you.
Ma'am, shall I start? Yeah, good evening, all of you.
Now
Good
I invite our respected Deputy Dean, Dr. R. Surekha ma'am, to deliver the inaugural speech. Over to you, madam.
And Pradeepa ma'am, please unmute your audio option, ma'am, please.
ஆமா நம்ம தான் பண்ணணும்
Dr. R. Surekha ma'am, please unmute your audio option, ma'am. Please unmute your audio option.
Good afternoon, everybody. Good evening, everybody, rather. Am I audible now, sir?
Yes, ma'am, you are audible, ma'am. Please
Yeah,
continue.
yeah. Okay, sir. So thank you so much for accepting our invite and this webinar. I'm told that there were many participants. Actually, I could see like a lot of, enthusiastic participants here who have joined this evening for this webinar. We are so grateful to have you, sir. As far as corporate secretaryship department is concerned, both the HOD, the facilitator Kaveri ma'am, and the faculties, especially the organizer of the seminar, Pradeepa ma'am. So congratulations and thank you and best wishes for doing this webinar. Because in today's world, we know there is the startup is given so much of importance. When we talk about our India's GDP, everybody now, since that not only the PM, the entire country has got that awareness that yes, let us use only Indian products. Let us, start our own business. Why we have to go and depend on the, I will say, the westernization companies for the projects? We will do our own projects. So I could see a lot of variations actually. And the best initiative is that Tamil Nadu government also has started this Naan Mudalvar. So once we started having the skill development training, now students are having that confidence that they don't have to go and depend on somebody else for job. They can generate their own funds. They can generate their own finance in the name of startups using their skills. So for such a startup business, when we have a resource person to completely enrich our knowledge with his expertise and how to raise a capital, for a budding business and all that when sir is going to give, we are very happy and blessed to have you. So I heartily welcome you, sir. Welcome for the session, actually. I wish the entire webinar is going to be a investor awareness program rightly mentioned. And I will say that this entire month, if you see, there are a lot of events there happening physically and online virtually in our college. And this event has its own benchmark because it is one of the, I will say, a very, very significant event which marks the impact of, capital funding and the finance generation for startups. This is also coming under the Innovation Institution Council calendar events, where this event will find its own prime significance. I heartily welcome I should welcome all the participants, the students and faculties who have joined now for this webinar. Have a very happy learning. Thank you. Thank you for the opportunity.
Yeah. Shall I start, ma'am?
Yeah, yes, sir. Yes, sir.
Yeah.
It's all yours.
Yeah. Thank you very much, Dr. Surekha madam, for your opening remarks, and Ms. Pradeepa and also Kaveri madam for giving us an opportunity to host this seminar on raising capital and managing finance for the startups. Basically, AMFI, you are aware that Association of Mutual Funds in India is more of into investor awareness program with SEBI, and what you are creating awareness in the field of financial literacy and investment awareness program. In that direction, I will try to. First of all, let me in the first instance itself, let me tell you upfront that I have some exigency which I could not complete the entire program thoroughly as I expected, but we look forward for another session, maybe in a month or two time, wherein we can cover exhaustively the topics that are intended. Having said this, as my opening statement, let us try to. I will come to this, this rising finances and for the startups in the end of the session. Before that, let the objective of SEBI and AMFI is the Investor Awareness Program. To create that, let us try to run through their presentation. Then I will come to the last. I will come to the subject of this topic given to me. When we are talking about investor awareness program, we have investors, we are talking about individual investors, and also business income for individuals. So in the sense, when we are looking at it, when any individual, when they get either salary income or a business income or a professional income, whatever it is what they will do with what they are getting. They will do the three things. One is, of course, spending. Most of it, around 60-70% of it, will go to our day-to-day needs and to maintain our standard of living, and then save something from out of the income that is being generated every month-on-month basis, and then try to invest the same in lucrative portfolios, so that he will get a second source of income. Next. So here, let us try to understand the whatever you must have heard of this name, Warren Buffett. He is supposed to be the international expert in investments, and his reputation is he is treated as an investment guru. So if that is what he says is, do not save after what is left after your spending. What he says is, identify and target your savings first, and the remaining amount only you spend. This is a very, very valuable cut, and definition or whatever you call it, statement he has given to all of us for the investors which are going to be starting their life journey. So when we are investing, there is one concept called inflation. Whatever savings we are making from our regular source of income, you find that there is a tendency, or there is an economic factor called that is inflation. If you look at the apple, you thought that you have saved a full apple, but because of the inflationary tendencies in the economy, you don't get the full apple. You will get only a portion of it is being taken away by inflation, and the remaining only you will get. Inflation eats up your savings over time. That is very, very important. You have to understand and proceed further in that direction. So this slide shows how the inflationary tendencies will impact your expenses as well as your income sources. If you look at it, if you want to lead a decent standard of living today, for example, if you want to spend 30,000 rupees, if you spend, you can lead a decent standard of living. But 5 years hence, if you want to maintain the same standard of living, 30,000 rupees may not be sufficient because of the rising prices, because of the rising indirect taxes, and all these things will impact your expenses. And for maintaining the same standard of living 5 years hence, you may have to spend 40,000 rupees. Similarly, after 10 years, it will be another 20 to 30,000 rupees excess. And also, the same way, your income sources also, your savings also will get impacted. Say you save today 1 lakh of rupees. What is the value of this 1 lakh of rupees in cash or in a fixed deposit after 5 years? Say, if you take the net present value, you will get only 80,000 rupees value for that. You thought that you have saved, 1 lakh. But actually, the real value of this thing is, you'll get 80,000. Similarly, it will, over the period of years, there will be a decreasing impact on your net present value of your income or savings, what you have done there. This is because of the inflationary tendencies. One has to guard against these inflationary tendencies when they are saving and investing. Next, what is the solution? How to guard against this? Having said that, one has to guard, then how to guard? The first is start saving from day one. The earlier, the better. Generally, the tendency of younger generation, the Generation X or whatever, Millennium generation, whatever you call it by name, the tendency is, keep on, spending, enjoying the life. When they get a few five-figure salary, they start, spending like as if there is no tomorrow, and they don't practice the concept called savings most of the time. And that's why what we say is start saving from day one and progress saving from investment. And that means keeping in the savings and deposit or a term deposit of a bank will not yield much of whatever you are anticipating. You have to have a decent return also on your savings. Not only saving is important, you should see that yields a good return for you to have a second source of income. Then put that money to work rather than accumulating or keeping it idle. You cannot keep it under your pillow or under your bed, all these things. You have to invest it in a lucrative way. So then you work hard to earn money. So make the money also. You are earning money by putting your bread and sweat. Then you see that your money also will work for you to have a decent standard of living. Benefit from the power of compounding. Compounding, simple interest and compound interest, everybody is aware, no? If you compounding interest is interest on interest also. Similarly, you have to see that your savings and investments will also get the benefit of power of compound. Next. Yeah, to achieve this, one should have a proper financial planning. What are the financial planning steps in financial planning? Define your financial goals first. When you start earning, define your financial goals first. What you want to achieve. After 5 years, what do you want? More than what you are having today. And, maybe several, in your life journey, there will be several milestones that will come to you. And you have to plan for all those things. Define your financial goals. Assess your current financial income. And then create an asset allocation and also evaluate the tax implications and invest accordingly and monitor. And after investing, don't keep idle. Okay, I have invested, let it. No, you have to keep on monitoring and reviewing your investment, how it is yielding, whether it is doing well or not. If it is not doing well, then you change the asset allocation. Like this, you have to keep on churning and by reviewing and monitoring it. Next. What is financial? Why is this financial planning important? This financial planning is important, first of all, to achieve your financial goals in a structured and disciplined way. And also, the next important point is to enhance your standard of living for a period of time. And third most important thing is to prepare for financial emergencies. In the sense, everybody's life journey, sometimes you will find in a very critical situation, maybe medical emergency, maybe some unforeseen expenditure. All these things happen. Maybe happy moments also will be there, like new addition to the family and housewarming ceremonies. All these, functions, marriages, education, expenses. All these things, there are various, financial milestones that you have to either emergency or a milestone you have to fulfill. Then also, because when you are saving and other things, when you are earning, you have to pay taxes also to the government of India. Income tax is there, wealth tax is there. You have to pay. Besides your indirect taxes, you have to pay these direct taxes also. So you have to plan for them also. And finally, the objective is to enjoy the peace of mind. If you plan in a proper and disciplined manner, define your financial goals, and accordingly saving and investment takes place, you will have a peace of mind. You need not worry, whatever may be the situation. Yeah, you will be having a very comfort in life. Next. Yeah, drawing back on the Warren Buffett's, definition or statement again, he says, never depend on one single source of income. Make investments to create a second source of income. This is very important because, as I said, you may be earning a salary income, you may be getting a salary income, but the savings and investments, what you are doing through that savings and investments also should yield like a second source of income to have a decent standard of living, taking into account the inflationary tendencies in the economy. Next. So, investing in the right asset classes can help create wealth in the long term. How? Means you have to choose your asset classes very wisely to have a decent return on your investment and savings. Sensex is one very critical source, important source of investment for you. The returns generated, if you look at over a period of years, generally the returns net of tax, any investor will get around 10 to 10.5 to 11% minimum to anywhere between 16 to 18% return you are going to get from out of this investments. Investments in stock market over different tenures will definitely give you a better return than in a fixed deposit or in a savings bank account. That's why you have to choose your asset classes very wisely, taking all the options available to you, or when you are investing. Next. So this is again the same slide is being shown in a graphic mode. So if you see June 83, if the Sensex is at around 10,000, BSE Sensex is at this level. Now it is at what level? It's huge. Now it is almost touching, I don't know. Now I'm not a keen follower on that, but 80,000 or so it is touching. It is really, only thing is you have to have a very, very cautious approach. You have to study the market in depth, and then only you can, venture into stock market investments. Otherwise, most of the time what happens in a exuberance of trying to get more money, people will burn their hands. The entire investment will get lost. All these things will happen. That's why I am telling you with a rider that you have to be very cautious while dealing with this, Sensex. Next. Yes, you have to determine why you are saving and investing. If you look at this is a tree type of thing where there are various branches, various your wishes or your needs, your requirements will be like this. Maybe family, then education, then after some time you require a car. After some time you want to enjoy with family and to have a house, and then finally retiring in a peaceful manner. This to achieve this type of disciplined investment, goal-based investment is the answer for that. Always invest in asset classes with your specific financial goals in mind. Next. Yes. Then what are the various options that are available to an individual investor or a saver? So generally you will find gold, stocks, bonds, property, insurance, and bank deposits. These are the generally, most known sources of various investment opportunities: gold and property, real estate, and gold is, of course, most sought after thing for all households. Stocks, some of them only will go stocks and bonds, but insurance, most of the people we are aware of the insurance requirements and their investment, and the easiest way of investing is savings is by way of a bank deposit. Besides all these six asset classes, you have one more asset class which is comprising the various qualities of these six what we have described is mutual funds. Mutual fund is it's like mutually beneficial schemes. Let us go deep into that at a later stage. Next. So make your investments work for you. We have already seen the definition of statement of Warren Buffett. Your investment should work for you. Your hard-earned money, it should work for you because you have worked very hard to earn that money. So the savings and investments also should work for you for all these statements. Why? First one is fighting for inflation for you and provide income when you need it, that emergencies, accessible and suitable, usable in parts and portions. Whenever you require, you can draw in portions and grow in value and appreciate it over time, and also realizable at a fair value and low cost. Proper asset allocation is the answer for all these five, your investments should work for you statement. All these five, asset allocation, if it is proper, then you will definitely get this answer. Yeah, next. So your asset allocation, you're all aware of this picture. What we are seeing is on the screen is a thali. In thali, you will get all various items. It's not in one item which you're taking. You're taking several items in the thali, and you will be your asset allocation also should be in such a way that your investment should be in various asset classes, so that you must have all heard. Now we have all heard about don't put all eggs in one basket. So the reason being, in case there is something some crash happens, your entire investment also will get leave alone returns part of it, your investment also will get washed away. So that's why your asset allocation should always be very, very critical, and it's like a balanced thali. Next. So asset allocation should match your financial and planning and goals. We have in the second slide itself, we said that you should have financial goals, predefined financial goals one should have, and a disciplined way of saving to achieve those goals. So your asset allocation should be in such a way that not one portion of your asset, your investment should grow in value over a period of time, and in some portion it will give you a returns which will act as a second source of income to meet the inflationary conditions. In between those asset classes, there is an asset class called mutual fund, which will have both the what you call characteristics of this. One is growth in value, and the other one is returns and generate income. These two are available in mutual funds only. So having said that, let us look at your investment portfolios and see whether you are investing in right asset classes or not. Next. So having representing the mutual funds Association of Mutual Funds in India, let us see what is mutual funds in a nutshell, and then I will come to your the topic of the day. Mutual funds. Yeah, next please. Yeah, what is a mutual fund? Mutual fund is nothing but the name itself says it is mutually beneficial scheme for all the investors. So because it's mutually beneficial, the mutual fund is a financial vehicle that collects money from various investors and invests it in securities like shares, bonds, and debentures. Anybody with an investable surplus can invest in these mutual funds with as little as 1,000 rupees also, few hundred rupees also. Investments in mutual funds is the most cost efficient as it offers the lowest charges to the investor. Not much of charges are involved in while investing in this. Say in case if you go to the real estate, what happens? You have to registration charges you have to pay, huge amount. Like gold, over a period of time, if you are going for ornamental gold, they will say depreciation, stones value, all these things they take off. All these things, the mutual fund is, you do not have this type of what you call, additional costs. And another important aspect with mutual funds is it has an efficient and expert fund manager to manage the funds collected from various investors. And only one rider, again, in the stock markets, I have already said that your investments should be market returns only, not assured returns. Unlike in a fixed deposit where you will get an assured return of 7% or 6%, whatever it is, here, when you are investing in mutual fund, there will not be any assured, returns. It is already, it is in line with the market, that is Sensex and this thing. You will get the returns. That is no issue returns. It is always market related returns. Then in the long term, even though you are having that concept called market return, in the long run, the tendency is the market returns are always overperform compared to the issued return portfolios. This is a very important aspect. Next. How does a mutual fund works? There will be a pool of investors. They will pull up their money and hand over that money to a very inefficient fund manager. And that fund manager will invest that in stocks and securities, and which will help to generate decent returns, which will be delivered to the investors. This is how the mutual fund works. Next, please. Yeah, why invest in mutual funds? Because there are several advantages here. If you look at it, low cost, few hundred rupees, you can start your investment. Convenient in very, very small amounts. Professional management is available to you by way of a fund manager, qualified fund manager, and then there will be risk diversification, because he will not put all the investments, the collected money in one type of securities only. He will broad base his investments in shares and bonds. So there will be risk diversification. And furthermore, the most important aspect is the mutual fund industry is regulated by SEBI. SEBI means Securities Exchange Board of India. This is Securities Exchange Board of India, like Reserve Bank of India for banks. This is for mutual fund industries and capital markets. The SEBI is the regulator, and very well-oiled machineries that work for you, so that there will not be any unscrupulous elements enter into the market and take away your investments or savings. So this is very, very important. All the acts in this mutual funds is transparent, and it is easily liquidable. In the sense, whenever you require your money, immediately you can go to the market and or submit your application for redemption, and within 1 or 2 days, you will get back your money. So easy liquidity is available. Next, please. Yeah, mutual fund structure and schemes. Let us also go into that. The schemes. Next. The structure is like this. As the name suggests that it is a mutually beneficial scheme, so the entire structure is organized by way of a trust deed, because trust is very important for all the investors. So when there is a sponsor who wants to start a mutual fund company, so first of all, what he should do, he appoints a board of trustees and as governors, a board of governors, to run the mutual fund company. So these trustees will float a company called asset management company. This asset management company will float various schemes by way of mutual fund schemes and collect money from the investors, and this asset management company will manage these funds through a fund manager by investing in shares and bonds. Next is another leg of stakeholders in this is agents and distributors, because the mutual funds, there should be a distribution network to sell those mutual funds and to collect a pool of the money. Maybe the individual investors may not fully aware of the how to go about it. So there will be an agency and distribution network. There will be bankers who will sell these mutual funds, and there will be fund accountants and fund managers. These are efficient, well-oiled machinery will be at work for you to generate decent returns for your investments. Another important player in this entire aspect is custodian. when the fund manager and the fund accountants, all these people, they invest your hard-earned money in shares and bonds, these shares and bonds will not be at the disposal of the asset management company. They can only buy and sell, but there will be a custodian who will safeguard your interest by preserving all these, shares and bonds that are purchased by your hard-earned money, and they will guard these shares and bonds on your behalf. These are the various players in the structure of mutual fund. Next. Yeah, types of mutual funds. There are, the mutual funds are generally divided by way of 5 types of mutual funds, by way of organizational structure, by way of management portfolio, by way of investment objective, by way of investment portfolio, and other types of funds. This is one way of. Under each category, you will find several schemes that are available for you to choose based on your risk appetite. Every person has a risk appetite. Every individual runs a risk appetite. Some may have have a risk appetite where they can withstand the shocks that are that may happen in the markets. So that they have the higher risk appetite. So the higher the risk, the returns will also be similar, correlated. They will be higher. Similarly, in all these categories, various funds will be available for you to choose based on your risk appetite. Next. Next, please. Yeah, run through this. Next slide. Yeah, no, come back. Next, come back. Yeah, categorization is also 5 categorizations are there in the mutual fund schemes. They are called equity schemes. Equity schemes means basically the scheme, mutual schemes that are floated under this. Basically, they invest in fundamentally in equity markets, shares, and the risk will be higher in this category, and accordingly, their returns also will be much higher in equity schemes. Debt schemes, there are passive funds like where they will go for debt, government securities and bonds and other things, where the returns are assured, and people with moderate risk will go for this type of schemes. There are hybrid schemes called hybrid schemes, the combination of equity and debt. A portion of it will be invested in equity, and a portion of it will be invested in debt schemes. So what happens? It's a mix of both characteristics. Again, here also the risk appetite will be moderate to higher only. Then there will be solution oriented, like retirement plans, children education funds. All these things are there. Schemes are there which will cater to a specific requirement in one's life journey. Then there are other schemes like which are replicate the index, exchange traded funds, and index funds, and all these are tagged to the index, BSE and NSE, and then accordingly the returns will be generated. These are the various fund schemes that are available in the mutual fund. Next. So I don't want because of the paucity of time, I don't want to go into the details of these schemes. Now I will come to the your topic of the day, that wealth generation and this is what is the raising capital and managing finances for startups. So the theme of our topic today, raising finances. Generally, when a startup is there will be 2 types of this thing. There will be technocrats and there will be entrepreneurs, and technocrat entrepreneurs. So technocrat means what? He has an expertise in the the field where he wants to start an industry. And promoter is a person who is having entrepreneurial ability and he has the resources available, part of it, and he wants to start a business venture. These are the two types generally. And when you going to start a startup, you require finances as a technocrat or as a business entrepreneur. One has to understand that in India, we have this entrepreneurial ability very much vibrant actually, and most of the people, because everybody cannot depend on employment and all those things, and this entrepreneurial ability itself is a great characteristic in our Indians. It not only gives you returns, substantial returns if your business venture is successful. It also provides a lot of families with employment opportunities. They will also, when they work for the industry, what you are starting. So what are the, sources that are available for you? Promoter, when you are coming out with a venture, you should have at least, not only have a business idea or a technocrat idea, you should have also some resources. Maybe the 10-20% of the resources should be with you at least to make a beginning. When that is there, even you have other resources. I will tell you that promoters will bring in the most of it to start the industry. And besides this, that fund is only just to what you call, expenses to start the business. It may require all those funds they will bring in. But what happens to the industry, which requires huge capital outlay sometimes? How they will raise resources? If you have a wonderful business venture, you can directly access the capital markets by offering your shares, to the public. But generally, unless the promoters are having a proven track record, the raising of resources from market will be slightly difficult. Even though you have a capital structure when you start company like Aadhar capital, paid up and issued capital and all these concepts, somebody has to subscribe to that. Promoters initially will subscribe to some of the promoters quota shares, but to start the venture, to kickstart the venture, you require substantial funds outlay. Then how you will get it? You have to fall back on various resources. One is a capital market, where you can directly access the capital market by way of issue of shares and bonds and raise resources to start that. Or, which is for a startup, it will be very slightly difficult proposition at that point of time to raise resources from capital market, because it's an unknown entity in the market. But banks are there. You have to have a project report for your project which you want to start, and that techno-economic viability has to be proved to the bankers that this is a good project, this has a very good viability, economic viability is there, and technical expertise is also available with us. And the market, you don't have any much of a competition in this type of area. So please provide us with finances so that we will start this venture and give you good returns by way of interest payment to you. You have to convince the banker. Techno-economic feasibility is the most important concept which the banker will look into while financing the project. So once you finance it, they may give you term loans, not only for starting of the acquiring of the land, business, industry and other things, plant and machinery, etc., but also working capital facilities they will give. Working capital means each industry has a product cycle. You know that, you are aware of it. Product cycle. That product, to meet that product cycle, you require working capital. that means raw material, converting into product and then marketing and selling, and all these things, and then sales. It is a cycle. To meet these requirements, one has to have the working capital requirements. Banks also gives term loans, which will be stretched for 7 to 10 years over a period of time, and working capital, which will be renewed every year. You will get it to run your industry. These are the major sources of your finances, besides the capital market opportunities that are available to you. Startup. There is one more class called private equity. Private equity investments means, because sometimes, you have an idea, brilliant idea as a startup, but sometimes which is, an unknown thing in the market, bankers may hesitate. There is one more player called private equity, venture capital, private equity. All these people, they choose. If you convince them with your idea, business idea, and then they will put forth the most of the, maybe 75%, 80% of the amount they will invest in your firm. And when the business venture succeeds, and there will be substantial returns that are available for this thing, because 80% stock holding will be with them, and whenever there is an opportune time, they will offload it and sell it in the market for 10 to 15 times returns. They will get it within 3-4 years, and that player called private equity or venture capital funds are also available for startups. Only thing is, you have to convince the venture capitalists and private equity players. This is a unique business venture, unique startup. And this will have a success rate, and you should have to give a detailed presentation on your business plan, how you are going to implement this, blah blah blah, everything. And just like that, they don't because you come up with a startup, they will not give you money, because money is money finally. So you have to convince them with your business idea and business plan, then only you will get your funds. These are the various sources how you will get capital to venture into startups and to run the business on successful lines. So I stop here because it's a detailed presentation is required for this, but because of some exigencies, as I already told you, I stop here, giving you the outlines on how to raise capital for startups. And thank you very much for giving me this wonderful opportunity, and wish you all good luck. Thank you.
Thank you for the wonderful session, sir. Although sir is not keeping back today, we are truly grateful that he has joined us despite his health condition. We thank him sincerely for his valuable time and commitment. Now, dear audience,
Thank you very much.
it's time.
I can take 1 or 2 questions.
Can you able to hear? Dear audience, is there any question? It's time for the interaction section. So if you got any doubts or clarifications or any questions to ask, then the answers will be shared with you from our resource person. The question is open to all. Audience, you can ask any questions.
Good evening, sir. I'm Darshini from BCom CS third year.
Sir, here is a student with her question.
Good evening, sir. I'm Darshini from BCom CS third year. I have a doubt.
Tell me, ma'am.
Sir, you have served in leadership position in SBI. What is the most important lesson you have learned in your journey?
Yeah, it's a very good question. The important lesson is, come what may, you have to keep up your, integrity at all times, and go deep into the project when you are financing, because being a banker, you are a trustee for the funds of the public. It's not that like, yeah, just like that, I cannot splurge on the just because I have discretionary powers. I cannot splurge on the funds that are available for loaning and advances. We have to be very cautious, and finally, trust and integrity plays a vital role in discharging the duties as a banker. This is what I learned. Am I clear, ma'am?
Yes, sir. Go on. Thank you, sir.
Thank you, ma'am.
Is there any other questions? One more student is here.
Sir, I'm Shweta from BCom CS third year, sir. I have a doubt. Based on your experience, vast banking system, what qualities should young entrepreneurs to develop or succeed?
Entrepreneurs. You're talking about entrepreneurs?
Yes, sir.
Yeah. Entrepreneurs, first, they should believe in their project. That is very, very important. Not only they should believe in their project, but also they should put in their, what you call best efforts to kickstart it, and also to see that the venture runs on a successful lines. Most of the times, what we find is the technocrat entrepreneur, first-time entrepreneurs, they have the business idea, but unfortunately, on the ground, they are far away from the realities. On the ground, what happens? There will be a lot of bottlenecks that will they come across while executing it, and also what we find is most of the time the entrepreneurs are over ambitious, and I can say that diversification of funds happen, even though there is a good business venture. But if you diversify, the funds that are meant for this venture to some other venture, it will lead to a situation where you will not, the working capital will get choked, and your business venture will falter. So you have to have a very good characteristics of stick to your business line and see that your venture is successful. Until then, you should be work like an employee of the company, not as a promoter. Promoters, just splurge the money once they have so many resources at hand suddenly available to them, they splurge. That is one most important causes for sickness, like diversification and splurging. And sometimes business cycle also plays havoc. Sometimes your business idea maybe looks very good on paper, but by the time it is executed, what happens? It may go obsolete. Maybe competitors' product must have already come into the market. So all these factors one has to take into consideration. Keep your eyes and ears open, how the market is changing, and accordingly you have to fine tune your business policies and practices, and to be successful in one business venture. This is very, very important. Yeah. Am I clear, ma'am?
Yes, sir.
Yeah.
So is there any other questions from the audience side? So there is a question in chat box. I'll just read it.
Yeah.
Saurav has asked, what is the difference between trustee, sponsor, and promoter in a mutual fund?
Sponsor and promoter is one and the same. Okay. Trustee means when a sponsor or a promoter company wants to start a mutual fund company, they first appoint trustees. board of governors, they cannot directly do the asset management company. The asset management company will be run by this board of trustees, like board of directors in companies' cases, and this sponsor promoter do not have any say in running the company. Okay, and the only thing is they can only invest money and appoint this board of governors, taking what you call believing in them, their expertise to run the company. So this is the hands-off approach from the sponsor promoter and the trustees of the board of trustees of the mutual fund, who are the real board of governors for the asset management company, which was floated by the promoter. So there is a what you call hands-off approach and arm's length distance between these two, promoter and asset management company and the board of governors. Yeah.
Thank you, sir.
Thank you very
Sir,
much.
here a student is waiting for a long time to ask a question. Yes, come.
Sir,
Yes, sir.
I'm Devil from third year BCom Computer Science, sir. I have a question on how
Yeah.
can student like us build financial awareness early in life?
How do people like you get
Build financial awareness early here in life.
yearly?
Early in life, sir.
Early in life, yeah. See, you are a BCom student, no? That's what you said. You should be knowing the nuances of commerce and the importance of finance in day-to-day life. You must be knowing it. But the thing is, early in life means as long as you are dependent on your parents. Not all of us, but most of the people generally they don't realize the importance of finances when the monthly income, monthly stipend, or monthly regular contributions are made by the parents. Not that I'm telling everybody is irresponsible or anything like that, but the importance we may not be knowing it, but how much blood and sweat has gone into those resources to generate those resources and giving it to you. So my take is you have to start very early. Even while spending your parents' money, you have to be responsible. You have to be aware how your parents are striving hard to get you this type best of everything in life, and that responsibility starts from family and from the childhood itself. So you have to while seeing it how how your parents are struggling, how your elders are struggling to contribute to your well-being, you have to behave responsibly. The financial awareness should start from there, and then by seeing it only, nobody will tell you about that. By seeing what is happening in your household, how your your parents are balancing the budget, taking care of the inflation and all these things. By seeing it, by observing it, you will come to know of it, and that is the first step in financial awareness. Then as you grow and as you start earning, then you will really know the value of your hard earning that is happening, and also your efforts, your blood and sweat that goes into for generating that monthly income. So it is awareness is it's a constant struggle. You have to keep on reading, keep on knowing what is happening in the market, how inflationary conditions are impacting your savings and expenses. All these things you have to keep your eyes and ears open, and accordingly, and don't go for Ponzi schemes. Some people may offer substantial returns for your investment. You should not fall prey for all those Ponzi schemes, and you have to be, because it's your hard-earned money. You have to guard yourself against such tendencies and invest wisely, and by studying the markets, or keep in mutual funds, which is better safe place than investing directly in the market. So this is how, it's a continuous journey, and of financial learning, financial awareness. Yes, sir. Ma'am, shall we take a call? Hello?
Hello, sir.
Yeah, can we stop here?
Yes, sir. Last one more question is being posted in our chat box. With
Yeah.
this, we can wind up, I think.
Yeah.
Sandhya S has asked, can a startup opt for a person, company? Will it be advantageous for the startup?
Can a startup ask for?
Can a startup opt for one person company? Will it be advantageous for the startup?
One person company.
Yes, sir. One person.
Yeah, one person company, is a concept, but not very well, publicized, in the this thing. But this is very good because you are insulating yourself from the, what you call as a company is a corporate citizen. No company, we are all aware it's a corporate citizen. We are insulated from the business losses and other things. Only your investment is at stake, not your personal, whatever the resources are there. That will not be touched with this one person company. It's very cost effective company, and because if you don't have much of a other people, you can start this, but not very popular at this point of time in the Indian stock markets. Yeah.
Thank you, sir.
Thank you very much, ma'am.
Yes, sir. Now I invite Dr. R. Bhavani, Assistant Professor, Department of Corporate Secretaryship, to deliver the vote of thanks. Ma'am, please.
Thank you, ma'am. A very good evening to one and all present here. On behalf of the Department of Corporate Secretaryship Shift to Agachal Manmal Jain College, it's my honor and privilege to deliver the vote of thanks for today's one-day webinar on raising capital and managing finance for startups. A special thanks to our respected Secretary, Mr. Udal Kumar Chodia, and Associate Secretary, Mr. Hemant P. Chodia, for their constant support and encouragement in organizing such knowledge-driven events. We are also immensely grateful to our Dean, Dr. M. Ramya, and Deputy Dean, Dr. R. Surega, for their guidance and motivation, which play a vital role in all our academic endeavors. I would like to express our heartfelt gratitude to our distinguished resource person, Mr. Veera Brahmarao Arekapadi, Senior Consultant at Association of Mutual Funds in India, Andhra Pradesh, and former General Manager of the State Bank of India. Sir, your deep insights, practical wisdom, and rich experience in the finance sector have truly enlightened us and offered immense value to all the budding entrepreneurs and students aspiring to understand the financial landscape of startups. Thank you, sir.
Thank you very much.
Thanks to our beloved HOD. Thank you, ma'am, for your constant support and inspiring leadership that made this event a true success. Your guidance is the quiet strength behind every success we achieve. Thank you for being the steady light that leads us with wisdom and heart. A special thanks to the organizing team member, Ms. N. Pratibha. A big applause to you, ma'am. Like butterflies that bring color and joy, you added life to this event with your energy, dedication, and teamwork. Your efforts behind these scenes made everything smooth, inspiring, and memorable. Thank you for being the heartbeat of this webinar. Keep flying high and spreading your magic like butterflies. Thank you, ma'am. Overall, thanks to Mr. Sabah Ahmad, Program Coordinator. Thank you, sir. A special thanks to our faculty members and technical team members, especially Dr. Julie Sudhir ma'am, Mr. Dhanagopal sir, Mr. E. Kannan sir. Thank you, sir. Thank you for your hard work and making this webinar a grand success. Last but certainly not least, a big thank you to all the participants, students, faculty, and guests who joined us today and make this session interactive and meaningful. Let us continue to explore, learn, and contribute towards building a financially informed and empowered startup ecosystem. Thank you once again, and have a great evening. Thank you all.
Thank you.
Thank you, ma'am. Thank you. Okay, so before we close, I kindly request all the participants to fill out the feedback form shared in the chat box. Your feedback is valuable and will also enable you to receive your certificate. With this, we formally conclude today's national webinar, and thank you for your patience and understanding and support, and wishing our resource person a speedy recovery in spite of spending the time. So I thank I thank very much for our today's resource person. Thank you very much, sir. And my overall thanks and credit goes to Sabzar Ahmed, who is the program coordinator. I thank you all and have a great time ahead. Thank you, sir. Thank you all. And now it's time for the national anthem. So let's all raise for the national anthem.